Well, hi guys, welcome to this Moneycontrol live stream. You're watching Morning Trade with me, Nandita Khemka. Well, news coming out of global markets are fairly mixed, given the fact that the Dow snapped a 13-day gaining streak rather, and GIFT Nifty hinting at a subdued start for the Indian markets. Of course, over the next 30 minutes, we'll be talking about all the stocks in focus, and of course, we'll also be getting all your stock-related queries answered by our expert on the show. So if you have any queries, send them in to us on our YouTube feed, and we will have them addressed. But before we do all that, let's take a look at the top headlines at this hour. Strong consumer spending propels the US second quarter GDP to 2.4%, higher than the estimates of 2% growth. Stocks, however, closed lower as the Dow runs out of steam after 13 consecutive sessions of gains, and the Nasdaq and S&P 500 to end lower. Stocks in Europe end sharply higher as the European Central Bank hikes rates by an expected 25 basis points. In fact, the commentary hints at a possible pause in September, even as inflation is expected to stay too high for too long. Asian markets edge lower ahead of Bank of Japan's policy decision. The GIFT Nifty, of course, is implying a lower start for the Indian market after a 0.5% shave off of the Nifty yesterday. We are expecting a subdued start for the Indian markets this morning. Brent crosses $84 a barrel. WTI crude hits $80 for the first time since April as US GDP growth beats estimates. Prices, however, come off highs in early trade in the futures market. Among key earnings to track today, of course, watch out for numbers from Indian Oil, Marico, United Breweries and M&M Financial, among others. Well, first let me get on board our technical expert for today, Hemen Kapadia of Choksey Securities, joining in this morning. Well, good morning, Hemen. Yesterday, of course, it was a down day for the markets. We couldn't sustain the gains, and we saw the FIIs also, turn sellers yesterday. In fact, the sell figure coming out of there is somewhere around 4,000 crore rupees, vis-a-vis DII buying of 2,500 odd crores or thereabouts. But, looking at the setup, how do you expect the August series to kick off? Would you say that, we could test levels of, the support levels of 19,600, or do you expect some buying to come in at, these levels?
A very good morning to Nandita. Excuse me. Thank you for having me. I think, like you mentioned, I think 19,600 is important. That is a support, and we've sort of taken support yesterday. See, we are sitting on top of a 3,000 point drive, Nandita, frankly speaking, without any significant correction. The setup otherwise seems fine. You have the world market joining in the rally. Like you said, Dow Jones went up 13 trading sessions in a row. 34,600 was a 7-month ascending triangle breakout level for Dow Jones. So that has now turned positive. Except crude, I think everything seems quite okay. The VIX is below 11. We are at 10.5. I mean, with such a low VIX, frankly speaking, one shouldn't expect too much of fireworks unless there's a lull before the storm and we see the VIX shooting up to 13 or 14. I think till that happens, yes, a normal correction is possible. Like you're saying, if 19,600 breaks in terms of closing, yes, the correction could deepen and we could see something closer to 19,300. Before whatever happened, I think the markets were already a bit iffy, and the Dow Jones, the Bank Nifty and the Nifty both posted a lower top yesterday and are sort of cooling off a bit. So stock-specific things are fine. I believe the mid-cap index posted a fresh all-time high yesterday. You have stocks doing well. But yes, I think one cannot ignore that, yes, markets are a bit jumpy at higher levels. Coming closer to 20,000, we've sort of slipped into a small consolidation mode, which might get exaggerated depending on 19,600. The corresponding level for the Bank Nifty is 45,600. Nandita.
All right, 45,600, the level to watch out on Bank Nifty. Before I move on to the next guest, Hemen, I want to get in your thoughts on Tech Mahindra. Given the fact that the numbers were, extremely disappointing, washout quarter, of course, the party for the IT stocks was spoiled by Infosys, but Tech Mahindra, worst EC revenues among peers. And yesterday, of course, we saw some bit of reaction on the stock, but it did manage to pare some of the losses in trade. We have a query coming in from Alexander T. He wants to know whether or not one should, look at Tech Mahindra and the sell-off that we've seen on some of these stocks as an entry price. What would you suggest you do?
After such a big sell-off, Nandita, one would need to wait for technical stability before venturing in muddy waters. That's what I would say. If he's kind of convinced about the fundamental, despite the dodgy results, then I think he can consider nibbling. Why I'm saying this is because 1060 is very strong support, Nandita, and Tech Mahindra has been moving here for almost 12 months or so in a range between 950 on the downside and 1165 on the upside. So it is at a congestion area. We've fallen off a cliff from 1270 to 1080. And frankly speaking, I think not exactly unexpected. I think it was more or less clear that IT numbers aren't going to be that great. Okay, there have been a few exceptions. So yes, if you're convinced and only if you're convinced about the fundamental of the stock, you can start nibbling over here. But I'm saying nibbling. Do not go the whole hog at one way because IT could be iffy. As of now, extreme short term, I don't think 1060 breaks in a hurry. It should take support and stay a bounce back.
All right, that's the view on Tech Mahindra. Hope that answers your query. We'll talk about a lot of other queries and stocks with Hemen in just a bit, but let me also bring on board my next guest for today, Madhuchanda Dey of Moneycontrol Pro, joining in, of course, to take stock of the IT report card. Good morning, Madhu. Good to have you on the show. You know, earnings across the large cap universe, of course, weren't all that bleak till a few days ago. When HCL Tech and Wipro handed in their numbers, people were expecting a weakish quarter from the IT giants any which ways. But, we saw a healthy rally come in, and then Infosys came out with numbers, guidance sharply lower. That really spoiled the party. And then, we also saw Tech Mahindra, of course, given a washout quarter. But we'll talk about Tech Mahindra in a bit. But for Infosys specifically, do you think it's a company-specific issue, given the fact that HCL Tech and Wipro, at least on the guidance front, they have, outdone what expectations were like?
Well, the rally that you saw in HCL and Wipro after their numbers was more to do with what was happening in terms of the US data points and less to do with their numbers per se. Of course, no denying the fact that Infosys guidance was way below expectations. I mean, a downgrade from 4 to 7% constant currency growth to 1 to 3.5% was not something which was expected. Nothing that we heard, from the company. In fact, they announced a large order just before their earnings release, a few days before their earnings release. But having said that, you have to remember that HCL Tech did stick to its guidance of 6 to 8%, but they delivered a 1.3% QOQ decline in revenue in constant currency. So seen in that light, the guidance is still very ambitious. And we have to remember that there is a slowdown, which is impacting discretionary spending per se, and that is impacting all IT companies across the board. But the variance in result that you see is depending on the exposure to verticals, exposure to particular clients. But overall, it is not like a great going at this point in time, and it is going to be a gradual and a very slow recovery.
All right, gradual and slow recovery, which makes me come to Tech Mahindra, of course. A dismal set of numbers, management commentary also not that encouraging. Of course, constant currency revenue growth has been the worst among large cap peers. But what did you make of the commentary per se? Do you think second half will be when we'll see some kind of recovery kicking in? And in that sense, can we expect Q2 to be a little worse than what we saw in Q1? Or do you think it'll be a little better?
For Tech Mahindra, this was a confluence of many bad things happening together. As they rightly pointed out, communication was down by over 9%, and that's like a very major chunk of their revenue comes from this vertical. There was a bankruptcy in one of the clients, and third, there was a seasonal weakness as Comviva, which is always there in this particular quarter. And having seen a 4.2% constant currency sequential decline in revenue, definitely you will see some uptick in Q2, and the worst is over. So H2 would be better. But the pace of recovery, as I had already alluded to, is going to be very slow. So don't expect any impressive numbers from Tech Mahindra in FY24. Because as they had also alluded to, there is reprioritization of spending by the communication clients. They're not willing to spend so much on 5G. There is a reduction in discretionary spending. So yeah, the worst is over, but this recovery is going to be very slow. So investors have to be extremely patient with these stocks.
Right. Investors have to be really patient, and the road to recovery will be a little longish and slow. But in that sense, do you think TCS is better poised versus its peers? It has given in a muted set of numbers, which was largely being expected. And their exit they don't give guidance, but their exit margin trajectory that they have indicated is somewhere around 26 to 28%. Given the fact that the margins came in at 23% or thereabouts, of course, amid wage hikes and the like, do you think margins they could achieve this margin, or do you think it's a lofty kind of a target that they have set?
See, they have clearly mentioned that this is an ambitious range of margin. This is an aspirational, I stand corrected. This is an aspirational range of margin for them. On one hand, the supply side is getting better for all IT companies. There is room to improve utilization. There is room to improve juniorization, and the wage increment pressure is also waning because the attrition is falling. But at the same time, we have to remember that the demand environment is still quite soft. The executions are not picking up as expected because clients are going slow even on existing projects, and they are cutting down on discretionary spending. They are cutting down on projects where they don't see a return on investment immediately. So in this environment, to improve margin dramatically is a tall ask.
Right, that's the view then. But I want to also get your thoughts on valuations. Of course, last quarter, when we were talking about IT valuations, they had come very close to long-term averages, but then we saw a healthy pickup as well. But right now, where do these stocks stand valuation-wise? Do you see more downside, and would you advise investors to wait it out before actually nibbling into some of these IT names now?
So I think, IT sector is very interestingly poised. On one hand, you have this whole macro concern, and we have to remember one thing, which is something which many investors are missing out amid the overall euphoria in the market, that we have seen the sharpest rise in interest rates in the US. So the cost of capital has got dearer for all enterprise. In this scenario, they are going to spend very wisely. And while spending wisely, while the overall technology demand remains very strong, the recovery, the kind of recovery that one is looking for, which we saw during in the aftermath of the pandemic, that is not going to happen, in the foreseeable future. So valuation will have to adjust. Of course, valuations have come off. But we also have another challenge, which the IT service sector is looking at, which is a meaningful change in technology, which is going to be ushered in with a generative AI. So, what kind of deflationary impact it is going to have on these service players? Of course, there's no denying that it definitely opens up a lot of opportunity. That also remains to be seen. So, the sector is very interestingly poised at this juncture. But I would like to make two clear distinctions here. One is for the large established players. Their growth is at most going to be in high single digits, in the next couple of years. But they are still going to throw a lot of cash, and they are going to generate a lot of cash in their business and give generous dividend. So as a dividend yield play, investors should start looking at some of the stable businesses like Infosys, TCS, where, with 3% plus kind of a dividend yield, they look to be, in a good place from that perspective. But if you're looking for growth, you have to look at some different sets of companies. For instance, from our coverage universe, in the large cap, we like LTI Mindtree from the growth perspective, because after the integration, they have the complete suite of products, and they don't have any client overlap, and they have the right size whereby they can really accelerate. So, but the stock has run up. So wait for some correction to play out. And definitely you should look at some of the agile, nimble-footed, middle-sized IT companies. where the earnings growth is, upwards of 20% CAGR, even in this environment. Something names like Coforge, Persistent, etc. But there too, wait for a correction to play out because the markets are also pretty overheated.
Right.
We have seen very good numbers from US banks. The big tech commentary numbers also have been good.
That's
But
correct.
yeah, things will change. And when things change, that's the right time to, selectively get into IT. Don't put, all your money in one tranche and be selective because as we have seen in this result season, there was good, bad, and ugly within the sector.
That's
So
correct. Madhu, I'm really sorry to cut you off, but we are running out of time here. Thanks a lot for taking out time and putting into perspective the entire IT report card, and how one should be poised when it comes to the IT sector. With that, let me go back to Hemen and talk about some of the queries that are trickling in. Hemen, I want to get in your thoughts on M&M. Of course, we've seen auto stocks jump up quite a bit on a YTD basis, but, the stake buy in RBL Bank seems to have dampened sentiment. For the last 2 days, the stock has been coming under a fair bit of correction. Yesterday, 6% down. How should one look at the stock on the charts now? We have a query coming in from Rajesh. He wants to know your thoughts.
A lower top, lower bottom scenario, Nandita, by M&M. And I believe we should be taking support at around 1420. That's also nearby of the 55-day exponential moving average. But yes, I guess this has punctured the move a bit, at least sentiment-wise. So, and we just, last week, we posted fresh all-time highs. So, time being, yes, I think it's taking a breather. There is a congestion area, like I said, between 1420 and 1360. So, I don't think it's a 60-point congestion area. I don't think this will break at the first attempt, and it will also provide support. Yes, we've gone down with a gap, a bearish gap, which is not a good sign. But as of now, yes, it's taking a breather. And frankly speaking, we've had a humongous rise. I mean, the last 1.5 years, the stock has gone up from 670 to 1600. I mean, give it a break. There's a time price correction needed. You can't sort of defy the laws of gravity permanently. So it's a cool off. The bigger picture still remains quite okay. Nothing changes. Short term, yes, we've gone for a toss.
Right, short-term pain on M&M. Let me talk about the pharma pack. Of course, we saw solid gains coming in on the likes of Cipla. In fact, Lupin also, one stock that was up 4% yesterday. But of course, there's some bit of good news coming in terms of US FDA relief for the company. In fact, US FDA has said that the Goa and Pithampur units, which it had given warning letters for in 2017, when those issues are resolved. And that was a big overhang for the stock, some of these regulatory concerns that were emerging. But now that has been resolved. So, Lupin, on the charts, can we expect higher highs? Right now, I think yesterday itself, it hit a fresh 52-week high. And of course, Cipla as well. That stock was like a high flyer yesterday.
Lupin is a bit different, Nandita, because Lupin has underperformed badly, in the sense the performance have been abysmal. Many of the stocks moved well, while Lupin posted a high of 2115 in April 2015. Now, 8 years and counting, we've gone nowhere. Now, Sun Pharma, not fair to compare stocks, but Sun Pharma has made a stupendous recovery, has almost come back to its all-time high. Probably it's time for Lupin to catch up. So I agree with what you say. I think higher highs, yes. Like you said, we made a 52-week high. Thing is, it has gone a one way from 630 to 990. So maybe there is a cool off built in somewhere, but the setup has distinctly improved. And at the risk of sounding overly optimistic, I would say that the 8-year cool off, decline, correction, whatever label you put on it, Nandita, from Lupin is on technical parameters over. I mean, worst is over, I'd say, from a medium to longer term point of view. Slowly and steadily, we should gravitate towards 1250 and more. So, yes, it does look positively interesting, Nandita.
All right, it looks interesting, Lupin, at the current juncture. But let's talk about Indian hotels. We have a query coming in from Kuntal, wants to know your long-term view on the stock. Of course, earnings came out yesterday, 30% jump in profit. I think the stock this week hasn't done all that well, if I'm not mistaken. But not very far from 52-week highs now. Do you expect it to, conquer higher levels, given the fact that, of course, hotel stocks have seen a good run after the kind of recovery they've seen post-COVID.
Yes and no. I think I would expect it to do well, but like you mentioned, we've been 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, almost 11 weeks and counting, and we've gone nowhere. I mean, you pointed that out. So I think that is already built. I mean, it is in there. The range is between 378 and 406. So I believe after this run up, either we break 378 and go down. It doesn't look particularly weak, but at the back of the mind, you just need to remember that stock has moved from 60 to 405 over the last 3.5 years. So we are sitting on top of a quantum jump. But yeah, shorter term point of view, if 378 breaks, fine. Doesn't look like that. But after 11 weeks of a sideways move, Nandita, if we expect an upside, we need to take out 406 decisively. If that happens, we'd probably see a 7 to 8% upside in a jiffy.
All right, that's the view on Indian hotels. I also want to talk to you about ITC, Hemen. Of course, we've seen the hotel biz demerger nod coming in, and of course, stock reacting to that as well. Street not happy with, of course, the 40-60, demerger ratio, and of course, the fact that it wasn't really a vertical split. And yesterday in the investor con call, the company has also clarified that the reason for going in for this structure. And the company believes that the return on capital employed will only increase by 18 to 20%, and it will be beneficial, and value will be unlocked for shareholders as well. Looking at the stock, it has had a great run. I think the best performing stocks on the index, if not the best, among the best performers on the index. Right now, the kind of dip that we saw, do you think this is the opportune time to just get into it, or would you wait for maybe August 14 when the company really gives more details about the whole process? Would you advise investors to look at after that?
I would prefer to play it safe. I would prefer to wait a bit. Like you said, phenomenal move. We're sitting on top of a 3.5-year move, and the stock has gone up from 135 to 500, almost 500, 499.70. Currently, if we close even at these levels today, Friday, so weekly charts are being made, Nandita, technically it would mean a downward bar reversal. So that does not inspire too much of confidence in the near term. Having said that, we are safely ensconced in a longer term up move. So either one, like you said, would wait for the mid-August event to take place, or one can start nibbling. We're at 465, support comes in at 455 and 435. So I would be more comfortable buying ITC once again in a small manner at 435, but only a closing below 455 would take it there. So I would say wait a little bit more, and if you are you have compelling reasons to buy it, please buy it in bits and pieces, because after such a humongous run, even a small cool off should give you a good opportunity. But once again, the longer term picture still seems absolutely fine, despite whatever has happened in the near term. Nandita.
Right, the longer term picture looks great. I just want to get in one last query then on the show. Chinmay Salunke wants to know your thoughts on BEL for the long term. Of course, numbers are pretty good, came out yesterday. What would you advise investors to do when it comes to BEL now?
3.5 years and counting, higher tops, higher bottoms. It's like Rahul Dravid batting, Nandita. Copybook technicals, safe stock. Every move is corrected by a small retracement and continues. So I would suggest a hold. We currently breaking out of 118 and 129 after 6-week consolidation. Looks good, long-term uptrend, very much in motion.
Well, that's the view on BEL then, and this wraps up our query segment for today. But of course, if you have any queries and if we couldn't take it today, don't worry, send them in to us. We'll take it on Monday, don't worry. But before I let you go, Hemen, any stock recommendations for our viewers for the this morning, or even for the short term or long term, whichever one?
They're slightly positional simply because Dow Jones, after, like you mentioned, under the 13 days, so a small cool off, which would percolate down to our markets as GIFT Nifty showing. So positionally, a buy call on LIC Housing Finance at 394, stop loss 384, target 414. Mechanical indicators buy above 55-day exponential moving average. Stock looks set for a further upside. And the second stock on which once again is slightly positional, not intraday sort of a move, is Granules India, Nandita. At one can buy Granules. I'm giving slightly lower entry points simply because of the markets are expected to open lower at 317, stop loss 306, target 339. We have entered an intermediate uptrend. Stock looks good, and even from a longer term point of view, stock is beginning to look pretty interesting. Nandita.
All right, LIC Housing Finance and Granules, 2 stock picks coming in from Hemen. With that, Hemen, thanks a lot for taking out time as usual. It was a pleasure chatting with you this morning. Well, with that, we've come to the end of this edition of Morning Trade. From me and the entire team, thanks a lot for watching. But don't go anywhere because coming up next is Opening Bell. Stay tuned.